Hello and welcome to Finance Conversation. This is the 47th episode of the Merging Life and Money Show, and I am super excited to be here today. For those of you who do not know me, I am your host, Marie-Jo César. I help professional women bridging the gap between life and money by acquiring and applying the relevant skills and knowledge they need to take control of their money, manage their finances, and understand that they can live their life, I should say their best life, with the money they have. Thank you for joining in today. If you are watching the replay, make sure to type #replay in the chat and leave me some questions and comments. Welcome, welcome, and welcome. I come to you live every Thursday at 5 p.m. Pacific Standard Time to share valuable information about how to achieve financial wellness and live your life with means and meaning. Today, my special guest is Eric Dudley, and I'm going to bring him in. And we will be talking about credit score. So Eric is an independent, experienced, I would say, holistic financial advisor, and he specializes in retirement planning, investment solution, and life insurance. He is also the founder and president of Dudley Financial Group. And if I must also note that one of the Dudley's Financial Group main goals is to help their clients build their best tomorrow while protecting them today. So welcome, Eric, to the Merging Life and Money Show, and welcome, followers and listeners. Thank you for joining in today. So grab a pen and a notebook, as Eric will be imparting lots of nuggets about your credit score that you would want to discuss further with family members, friends, colleagues, because it is all about sharing value that could benefit others. So if you have any questions and comments, make sure to put them in the chat, and as normal, and we will get back to you on any question that you may have. And as you may know, the main objective of the Merging Life and Money Show, and my very strong why, is to empower as many women as I can by teaching them what I know about money and finances. Today is Credit Score Day on the Merging Life and Money Show. Not to be confused with your credit report. So we will be focusing on 3 points today: how to look up your credit score, what makes up the high impact section in your credit score, and what are the low impact section of your credit score. So before we start, so how do we define credit score? Your credit score is a number that rates your credit risk. This 3-digit number measures your ability to pay back loans and any other form of debt, right? It helps creditors determine whether to give you credit and decide the term they offer or the interest rate they will charge you. So note that having a high credit score can benefit you in many ways. It can make it easier for you to get a loan, rent an apartment, or lower your insurance rate. Also, credit companies calculate your credit score using information from your credit report. So Eric, now that I define credit score, I have 3 questions for you. The first one is, how do you check your credit score?
Oh, hey, thanks for having me, MJ. Well, I thought that this would be a good topic to do, just because, I'm sure a lot of people ran up credit card bills during the holidays, which is an American tradition here in America. So, and they probably want to know, exactly how credit scores work and how to make sure that their credit scores aren't affected. So you can check your credit score at a number of places, but the one place that I would recommend is a place on the internet called Credit Karma. The reason why is because it It will allow you to find out how your credit score was determined by looking at the 6 areas that the credit bureaus look at. And you'll be able to see which ones you're strong in and which ones you're not strong in, so that you can start working on the weak areas. And you can do this, you can find out the credit score without it actually hurting your credit score to check. Because as you'll find out later, anything what is called a hard inquiry, okay, like whenever you check with the mortgages, if you qualify for that, or with car loans, they do affect your credit score if you check and check again. And too many checks will reduce your credit score. But if you check through Credit Karma, it doesn't affect your credit score at all. So it's free, it doesn't affect your credit score, and it can give you a lot of information.
Great. Thank you so much for that. My next question is, what makes up a credit score?
Well, there are 6 sections that make up the credit score. And the first 4 are what I call the high impact sections. And the last 2 are the low impact sections. Okay. The first one is, I'm sure nobody's surprised by this, your payment history. So do you pay your bills? Do you pay them on time? Is anybody having to go through collections to get their money back? And that's the most important aspect to credit scores. If you have anything in collections, your credit score is going to be greatly affected. If you have late payments, it's going to be affected. So one of the best things to do, of course, is to pay bills on time when you're supposed to. If you're unable to, one of the best things that you should learn is to make sure that you communicate with creditors. A lot of creditors will just be okay with if you're going to be a little bit late. You can put you in payment plans if you're having trouble, but make sure you communicate with them, because if you don't, it'll be reported to the credit bureaus. If you just set up a plan, you can avoid that. The second part of the high impact section is credit card use. Now, what that means is that if you add up how much credit overall total that you have, the credit limit that you have. So let's just say you have 3 credit cards, and one of them's for $10,000 limit, another one's for $10,000 limit, and another one's for $10,000 limit. Okay, that means you have a total limit of $30,000. Okay, if you have $27,000 in credit card debt, then that would be a bad sign. You don't want to be at 90% credit card usage. Okay. What the credit bureaus would like for you to be at is no more than 20% on average. Okay. Now, obviously, you can go a little above that during Christmas season and things like that, but then you pay it down back to under 20%. That's what they want. That's what they consider to be good credit use. Okay. The third high impact section is any derogatory remarks from creditors. Anything saying that yes, they're not paying, anything that says we're throwing it to collections, that's a bad sign. And then the fourth one is the credit age. Now, I tell you what, I was really lucky. My father got me to get a credit card when I just turned 18 years old. Okay, so that was like 2010. I'm just kidding. I'm much farther back. This was before they actually had the internet. So, but anyway, he got me to have a credit card when I was 18 because he wanted me to have a large history of credit. The farther back you can go in your credit age, the better. Credit bureaus like that. So that's the high impact section.
Okay. So thank you. I mean, it's a lot to take in here, and it's a lot that people don't know, the credit card users. And very often they wonder why, they find themselves with such a high rate of interest when they do apply to get some kind of loan or whatever. So my third question to the first part is, what should one do so that their credit score does not reduce?
Well, okay, like I was saying, the main thing is to make sure that you pay all your debts on time. And I think in one of our past episodes, we talked about having a budget, making
Yeah.
sure that you're on budget, making sure that you know where your money is and you're in charge of your money. And
Mhm.
that, of course, is the same thing here. making sure that you have the money to pay your debts, making sure that you can keep up with the payments and are never going to have anything in collections, anything late is the key. But it's also, like I said, not getting into using most of your credit. That's not a good sign for your credit for the credit bureaus either. And of course, the longer you've had credit, the longer you've had a good credit history, the better also.
Good. Thank you for that. Also, you talk about Credit Karma, and there are a lot of other such entities around. But can you tell me more? Can you explain what a FICO score is?
Well, FICO score is almost like a credit score. The Fair Isaac Corporation. I did not actually know what FICO meant or where it came from, but basically, its FICO score is just an estimation by creditors to what's the likelihood that you would become 90 days late on a payment. Okay, and it's very similar to a credit score, but that's specifically what the FICO score does. And again, it can be used to find out if you're going to be good for a mortgage loan or a car loan, even jobs. Jobs are these days having credit checks to make sure that you are a good risk because they consider people who have poor credit scores to probably not be as responsible in their jobs too.
Yeah, this makes sense. This makes sense, particularly if you're looking for a position in the finance space. I would think that this would matter, right?
Yes.
My second question for the show is what makes up, and you mentioned it before, the high impact section of your credit score?
Yeah, that's the payment history, the credit card use, the derogatory remarks, and the credit age. Now, would you like me to go into the low impact sections at this time?
Yeah, before you go into the low impact,
Mhm.
can you tell me the difference, or I should say, the different credit score ranges? Do you have any
Sure.
idea? Yeah. Mhm.
Okay, well that's a great question, and right now the according to what I looked up, okay, here it is. The most latest statistic is if you have a credit card score of 767 or higher, you're considered to be excellent.
Mhm.
Okay, if you have a card score of 681 to 766, it's good. And then 614 to 680 is favorable. Most people fall in the average of 583 to 613, which is average, and then below 583 is below average, and anything below 526 is considered unfavorable. So you definitely want to make sure that you're in the at least favorable range, above 614 if possible. A lot of people in America do have decent credit card scores, but if you don't, then it can really cost you.
Oh my goodness, that's important to know because I could tell you when I do talk to people, they seem to think that okay, if I have a 600 plus a little plus, I am doing very good. No, you're not.
Hmm.
No, you're not.
That's right.
Yeah, so no wonder all the credit card companies and the banks are making banks
Yes. Yes.
from poor creditors.
Hmm.
Yeah.
Yep.
So last but not least, certainly not. What are the lower impact section of the credit score?
Okay, the other two sections, yeah, they're considered low impact. And when I say low impact, it just means it's not going to affect your score as much. The total accounts. Now, you might think that a credit card bureau would say to themselves, "Well, they've only got three accounts for credit cards or creditors, and they are completely up to date with them. They paid them off. They're doing a great job." But no, the creditors don't like that. Actually, the creditors like whenever you have a lot of credit accounts open. They like to have anywhere between 11 and 20. Now, I'm not recommending to have 11 or 20. Okay, I'm just saying if you wanted to raise your score a little bit more, you should have between 11 and 20. I personally, because it is a low impact section, don't recommend that because, of course, you don't want to You don't want to have to keep up with that. And too many open accounts may be too tempting. Um, and then, of course, the last one is what we talked about earlier, the hard inquiries section. Anytime that you have people checking your credit history or credit scores for mortgages, for car loans, for job history, for jobs, then yeah, it's going to ding your score a little bit if it's multiple times. Now, during a period of a quarter, if you're checked between 0 and 2 times, that's great. If it's between 3 and 4 times, that's okay. And between 5 and 9 times, that starts to affect it negatively.
So that I understand. So if they are inquiring about your credit score, you get penalized.
Yes, that's right. Too many times. Now you can get it checked. You can get it like if you need to get your credit score checked for a mortgage loan, and you get it checked 1 time in a quarter. That's fine. No, nothing's going to happen. 2 times, still good. 3 times, it starts affecting it. Okay,
So
so you
tell
don't
me,
want to
so
continuously get checked.
so tell me something. They have people have access to their, and maybe I'm not understanding. I want to clarify. Let's say an entity like Experian,
Hmm.
right? So if I wanted to know where I stood, I would go there as often as I want. Am I getting penalized for that?
Okay, no, no. I'm just talking
Okay.
about for mortgages, for car loans, for jobs. All of those would be hard inquiries. Now,
So, which
if you
would
go to
be a
Experian.
third party
Mhm.
inquiring into your credit history.
Right. If you
Okay.
go to an Experian, that would be like Credit Karma. I don't think
Mhm.
it would affect it. I'm not actually familiar with Experian, but it's
Mhm.
probably just like Credit Karma, where it doesn't actually affect your credit score.
Yeah, I mentioned Experian because
Hmm.
it's well used and talk about it on TV and all that kind of stuff, right?
Right. Yeah.
So it is again if a third party checks on your credit history record or whatever you want to call it
Hmm.
too often, then you will be dinged.
That's right.
Okay, good. Fine. So I mean, this was very, very, very interesting this afternoon. Things that because America has a lot of credit card user, and unfortunately, a lot of those credit card users are not familiar. I mean, the credit card meets you in your mailbox. However, it does not necessarily come with any instruction other than your credit limit is,
Hmm.
right? And
Right.
and I always say because your credit limit is $10,000, you don't have to spend it all. Remember, you got to pay it. And if you pay it within the same period that you spent it, this is even better, right? And the analogy is because a car goes to 220 miles an hour. Okay, you don't drive to 220 miles an hour all the time.
Right. Hopefully. And by the way, that's not good for life insurance quotes either. If they find that out.
Exactly. So, but it's worth mentioning because too often, as I said, you get the credit card, and I know a lot of people are using their credit card balances as income.
Right,
Okay?
right,
I
and
mean,
you're right. I mean, it's certainly it's supposed to be just for convenience and
mhm,
for emergency situations. And if you do your budget the way you should, then it
mhm,
should be paid off at the end of the month. That's the best way to use a credit card. And of course, then the credit card companies offer you all of the benefits, all the rewards for using it, like the airplane miles
right.
and cash back. And I mean, it
Yeah,
can be really profitable if it's used in the right way. And
correct. And when you mentioned 10 or 11, I'm like, whoa, you would need an assistant to help you manage all these
yes.
all
Well,
these situations.
and another thing too that people don't realize, I mean, you wouldn't be able to keep your 10 or 11 credit cards open unless you use them consistently, because a lot of times credit cards will drop off and become, they'll be canceled if you don't use them for a 2-year period. And so you'll lose the amount of accounts. Okay. And you'll also, and that's the low impact section, but also you'll lose the amount of credit use. Okay. Which is in the high impact. So like, for instance, if you got 12 credit cards and that makes up $30,000 of total credit, well, you haven't used a credit card that has a $3,000 limit in over 2 years, so they just cancel it. You don't have $30,000 now. You have $27,000. Okay, and so that now affects how much credit use you have, and the percentage being above 20% would start affecting you negatively. So it all works together. I think that keeping it simple is probably the best way. Only have a few credit cards, and use them responsibly.
So you get to use them up to that 20% or whatever, and then you still have a bunch of credit available in case of an emergency.
Yeah, that's right. And if it's under 20%, it'd be easy to pay off too.
Yeah, totally. Well, so this is good information. So again, thank you for enlightening us about the importance and the impact of having a high credit score. Okay, so this is very important, and it gave us a lot to digest here. So I'm going to wind down and sum it up. Today we focused on what makes up your credit score and how to look it up. We talked about the impact sections in the credit score, and we talked about the high impact and the low impact sections of your credit score. So my last thought on that credit score, as far as I can see, they seem to operate like grades in school, right? They are designed to quantify your financial habits and assess your ability to pay back loans. So your credit score directly affects the rate of interest you will be charged for certain services and products. So having said that, folks, it is a new year. So I will implore all of you, if you have not done so, to please tidy up your debt and credit situations. I read somewhere that debt and credits are considered modern day slavery. So do your best to break free. The truth is that while your credit score is not everything, it can have an impact on almost every aspect of your financial life, from getting loans to buying a car, to renting an apartment, to getting a job. So yes, you should care about your credit score. Remember also that there are many ways you can improve your credit score as well. So start by checking that your information is correct in various credit reference agencies. And if it's not correct, make sure to get it corrected. You owe it to yourself. And another way to help you keeping a good credit score is to pay your bills on time. Okay? Late payments can have a lasting consequence on your financial health. All right? So before I forget, Eric, tell the audience how they can contact you should they need to. And I'm also going to have a banner as well that I could show with your information. So go ahead and tell them, just in case, if you want to reinforce your phone number or anything specific.
Okay, well, you can go to dudleyfinancialgroup.com and contact me through there. You can set an appointment in the upper left-hand corner, or you can just contact me through LinkedIn at Eric Dudley. I'm right there, and talk about all my services, and check out my about section for what I do, and it's got all my contact information there.
Great. So I hope that you have enjoyed today's show. And as you know, I like to end it with a quote. And today's quote is from my dear friend Susie Orman, and it reads, "I have always advocated doing everything possible to pay off credit card balances because it is good financial management and the ticket to a strong FICO credit score. So again, thank you, Eric, for your awesome contribution to the show today. We will meet again next month. Can you imagine? January is almost done. So next month, on the 17th of February, with another great topic. Thanks again, Eric.
Sounds good. Thank you, MJ.
Good. For more information about how to achieve financial wellness from the inside out and live a purposeful life with the money you have, join me next Thursday at 5 p.m. Pacific Standard Time, 6 p.m. Mountain Time, 8 p.m. Eastern Time, 9 p.m. Atlantic Time for my Bermuda peeps, and 10 a.m. Friday morning, Brisbane, Australia time. Thank you for being here today on the Merging Life and Money Show. I am your host, Marie-Jo César. I will be back again next week. Until then, continue merging life and money. Bye for now.